Good morning, good morning, good morning, guys. This is Vinney Chopra. As you know, I come live to you almost every week in my podcast, Syndication Made Easy. Many of you might have read the book. I just started the podcast as a sequel to the book, and now we have the Spanish version also. Oh my gosh, Vinny's doing all that. And then my new book just came out, guys. I don't know if you know that. Positivity brings profitability. Anyway, please subscribe to my channel, share, comment, and give us some good reviews so that we can bring some great personalities to you. Again, this is Vinney Chopra, and my very good friend Brandon Brown is here today. Brandon and I have worked together for many years in the Houston market and in the Atlanta market. And he's a great friend of mine and a great personality. We're going to dig into it quite a bit about capital markets with Brandon Brown from LMI Capital. Let me introduce Brandon. Formally, Brandon is a managing partner at LMI Capital with over 19 years of real estate finance and transactions experience. Brandon is primarily responsible for sourcing debt, mezzanine loan, and equity for all commercial properties, including all kinds of them: multifamily, office, retail, industrial, and self-storage. Additionally, he has formed strong relationships with capital sources, including local and national banks, life insurance companies, CMBS lenders, agencies, pension funds, and private equity firms. Brandon is an active member of the Mortgage Bankers Association, National Multifamily Council, Urban Land Institute, and a certified commercial investment member. He holds a BBA from Texas State University. Let's welcome with today's show, Brandon. Thank you, bud. So glad for taking the time to be with me. And I want to take my audience back to you because when I came in 2013 into Houston area, and then we started buying like 10 properties, I think we bought there, one after the other. And you were the ironical person that I came in touch with you. And man, oh man, you changed my life, really. So I appreciate you. And tell me a little bit short bio about yourself, how you got into this business and what prompted you. I know you are the director, senior director now. Kind of tell us more about it. Yeah,
I was living in Austin at the time, and I'd come out of college, was working in just corporate America, and had a friend that was here in Houston that was a investment sales that was doing apartment sales, and it was kind of intriguing when I would come to town and listen to him about what he was doing. There was someone that he did some business with that was looking for someone young to kind of come in and learn the ropes, and it was on the finance side. So I met with that gentleman, and the rest is kind of history. I like the fact that it's a people business, and you kind of control your own destiny as far as originations and working with people.
Totally. When did you join LMI? Did you work with some other banking company before that, or how?
No, joined LMI in 2001 and have been here ever since.
Wow, 19 years, going on 20 years. Awesome.
He kind of winded down from the mortgage banking business, and in 2016, me and my current partner took over the firm.
Yeah. Wow. Kind of, tell us again, what your services are. How do you qualify syndicators like me or investors, and how small a loan and what to look for, all the good things which my audience would love to know, how to qualify for a great loan with Brandon.
Sure. I mean, we get the calls all the time, so primarily it just comes down to your financial strength and what your buying power is, I guess let's say, or borrowing power. Net worth and liquidity are the main drivers of how much you can go borrow. But, we're looking at income assets, right? So like when you approached me, we were looking at certain types of transactions that needed certain type of funding. LMI Capital, we're not just a one-stop, shop of one kind of loan. We're a one-stop shop of many buckets of money and different types of loans. So when people call, we can have the conversation about qualifying for loans, but the reality is it's really more about the property, the business plan, the hold period, and that. And then that tells me more about what kind of loan we're going to go after, because there's different requirements with different loans. As far as what LMI does, as far as minimums, we try to stay $1 million and above, primarily because at $1 million and above, we have access to agency loans and other correspondent type of lending that they just don't go below $1 million. So below $1 million, it just becomes more of a, your traditional community bank kind of loan. And above that, we're able to kind of, come in and really add some value, I guess, to the process more so.
Surely. Now, how about the net worth? I know I've always thought about in my mind that up to maybe $10 million loan, you have to have a net worth more than the loan balance or loan amount, or is it lower level than that?
I think on up to 10 million, we typically just stick with the 1-to-1 ratio. Yeah. Net worth needs to be what the loan amount is. There's a little wiggle room there, but you have to be pretty, you need to be in the ballpark. So if you're borrowing 7 million, you need to show 7 million of net worth.
Yeah.
But like you said, above 10 million, it kind of changes. When you get to like a $20 million type of loan, it's not so much the net worth needs to be 1-to-1 as much as you got to have strong net worth, close enough. Liquidity plays more of a role at that point in time. And at a $20 million loan balance, I think they're also looking for, some good experience, schedule real estate that's I would say doing well, in today's market. The schedule of real estate really gets looked at just to make sure that all the properties are cash flowing and meeting debt service.
Sure. So the SRE, or the schedule of real estate owned, occupancy levels and different things of how your portfolio is, how they are performing when you bought them, all those things. How about during COVID? I know we are in the COVID right now. How has that changed the whole ballgame?
I think in general that leverage is maybe just a little off. The agency lenders at full leverage today are requiring 12 months of P&I as a holdback in addition to the ongoing escrows, but there's release provisions on that, basically a 6-month wait, and then they'll look at your trailing 3 income to release that P&I requirement. However, the rates are still very low. We just closed on a $22 million refinance, 75% leverage, 5 years interest only, and the rate was 3.13. So there is still some great, financing out there. It has affected, I would say, from the leverage standpoint. We're shopping some properties right now with some similar bank loans that we did with you. 75 and 80% financing. We're seeing a little bit more of the 65 and 70% primarily, with a few groups stepping up to 75 for the right sponsor or property, I would say. But in general, I would think leverage is most impacted. Rates are still great.
Rates are, it's very, very cheap money. You're so right about it. Even during COVID, even though I've seen lesser deals come, and maybe even to fruition and to be able to do the due diligence and all that, happening. But I do remember, how you helped me a lot where I bought C plus assets there in the south of Houston market, and you were able to get me 80% LTV after renovation or something. And you had so many, friends and, vice presidents of the local banks that you knew, as the palm of your hand, and you have lunches and dinners with them. So you were able to put together this matrix. I still remember that. So, yeah, how do you go about, like if somebody wants some construction, CapEx, for example. Right? So how does that really go into the whole equation? Kind of explain in simpler terms for our audience.
Really, we're just lending on a loan to cost scenario. So we'll take the price plus the rehab dollars, and those two numbers combined is where we're, as you mentioned, doing the 80% loan to cost. And it kind of goes back to what I mentioned earlier. It's more about the business plan, the property, what we're trying to achieve. And in this instance, we were looking to renovate, reposition, add value. And so we knew we wanted to go to certain buckets of money, which is really banks and bridge financing.
Yeah.
The bridge financing allows us to lend on a cost basis, gives you the rehab dollars included in the loan. Loan closes, you start to do your work and then draw the funds from the bank as you complete.
Yeah.
And usually these loans are, as you know, a little shorter term, but more flexible in the prepayment penalty, which allows you to, sell or refinance and capture that, gain.
Surely. How would you tell some syndicators or people who are pooling money together like I do, and I have a lot of investors in my academy, who are learning these tricks. So when should they start talking to a loan broker like you,
Sure. Yeah. No, I think the time to talk to us is when you're getting serious about it. Let's review your financial statement. Let's talk about your borrowing power. Are there going to be any other key principles that maybe, sign, maybe do a larger transaction, get a plan together on the size of deal, and then market and try to find that deal that fits in the bucket size that we're talking about. I tell sponsors, once they find something that looks reasonable as far as the numbers seem to work, or they like the real estate, then that's the time to give us a call and let's talk about the actual property, because the property is really going to drive the majority of the financing,
Sure.
What it would qualify for. And then the sponsors and like yourself, you're just a support on the backside as far as financially.
Totally. I know I always appreciated how well your whole, the systems, right? Your people in the office were able to do so much work and carry the loan, and we always closed on time. That's one thing I remember, and that's a huge relief to anybody who's taking a loan, right? And because you have so many other stresses coming along the way,
Right.
if the financing, the piece is taken care of, then everything is taken care of. I always believe that. I mean, if the money doesn't come at the end from the investors and from the bank, we are in deep
Right.
trouble.
Well, the lenders are putting up most of the money, right? So
Yeah, so true. I mean, the leverage, that's the name of the game.
Right.
With the stock market, you could pay 100% to buy Google stock or Tesla stock or anything.
Right.
But in real estate, you're able to leverage it 70%, 80%, and that's the best thing about it. Because the banks and the institutions and the, Fannie and Freddie, they are out there to give you money because they believe in the real estate, transaction, and they believe in all that. Let me ask you a question. How do you see this whole toxicity? I call it toxic on the rent roll right now, with the moratorium on rent, evictions and things like that. I'm sure lots of C class, C minus, even, D class are getting hurt because, of the unemployment and all those things. So what has it done in your field? What are you seeing out there?
Yeah, it's a mixed bag, I think, of depending on the asset. It might depend on how capitalized the property was or the type of loan they had. Locally, thank goodness, for the most part, a lot of our clients and the properties that I've been looking at, the collections have been pretty good.
Pretty good.
As far as, the potential. I feel like there's always going to be a tenant or two here or there at each property that, is maybe playing the system a little bit and knowing they can't be evicted. And so there is an impact there, obviously, on the rent roll. But I think as a whole here, for what I'm seeing, things have been pretty positive as far as collections, collecting, say, 93% of really what they should. Sometimes, more so. But again, I think it's kind of a case by case on the property. I do think there's an impact out there that maybe I'm just not seeing. And those properties maybe are not trying to refinance or transact, right? Because they know their numbers aren't really solid right now. So I just think all those properties are going to have kind of the kicking the can down the road a little bit. And, you know, first quarter, second quarter next year, those probably are going to be opportunities.
I think you're 100% right. That was my next question. I really believe that with this, it's not forgiven. It's just forbearance, you know, for
Right.
2 months or 6 months, and
Right.
lots of, you know, owners will be getting their not only P&I, principal and interest, but also 1/12 of the missed months, right?
Sure.
Coming to the mortgage and so forth. And as the moratorium lifts up, I'm sure they want to evict the tenants and, you know, get the new tenants in that will have more deferred maintenance of make readies and everything. And
Yep.
then, of course, all that is going to, and maybe some of the owners who have been having good equity in the deal, they might just say, okay, let me just sell it, you know. So opportunities, you think maybe in the first and second quarter of 2021 then, huh?
I think so. I think we'll definitely start to see some opportunities at that time with the exact scenario you mentioned, where people are coming out of forbearance or just, you know, have, I guess, struggled a little bit through capital, you know, to put back into the asset for the right kind of make ready. And they're probably going to be.
Sure, there'll be some opportunities coming. So let me ask you a question. Does LMI write loans all over, or mostly in the Midwest, in the Southeast, or how?
All over. You know, we've done deals obviously in Atlanta together. Closed some in Nashville recently. We've done some in the Memphis area. Working on one right now in Broken Arrow, Oklahoma.
Oh, Oklahoma, yeah.
Yeah, so we go wherever kind of the client goes. We're not out actively marketing to these other markets. We have clients that, you know, own assets in you know, different parts of the country, and so they need a loan, and we're here to, you know, to go figure it out and make it happen for them.
Sure, sure. Yeah, give us a little bit more perspective to the audience, if you would, like Fannie and Freddie. And a lot of times they're saying both of them sometimes are fighting with each other to give a good operator a loan. So
Right.
what does that mean? I mean, they are the two branches of the government, right?
Right.
Yeah. So
Yeah, I mean they're both. I mean, they're the same, but they're different. You know, in certain markets they look at deals differently. Here locally, and you know, in our submarket, Fannie seems to be more the go-to for, you know, the workforce housing, let's say. And Freddie seems to be, you know, really stepping out there and getting aggressive for maybe some of the nicer assets, you know, their deals. However, you know, the Freddie small balance loan that they came out with a handful of years ago is really, you know, something that a lot of people tap into here locally. It's $7.5 million and below. And so there's a lot of good, I guess, terms you can get with them that are more flexible in prepay versus having yield maintenance. But as the two, they're similar as far as kind of the loans that they write, but they just seem to, you know, anyways, locally, they seem to just kind of like a little bit different product, and one will get more aggressive on, you know, a certain deal versus another. And usually it's leverage.
It's the leverage. I see. How about the rate lock? Can you kind of expand on that? I know many times you have to pay some basis points so that the rate is locked for 60 days, right? Is that right?
Yeah, it's well, no, it kind of depends on the deal, on the program. So on the Freddie small balance loan, when you're issued an application from Freddie Mac, that rate is pretty much locked in at that point in time. You send your application and you have 45 days to complete the process of appraisal, inspections, all the credit information, and then that goes back to Freddie. They bless it, they issue a commitment, and then you go close within a week or so. And that's rate locked at application.
Okay.
Sword though, because if rates are falling, you don't get the benefit of the new, you know, the market. Traditional Fannie and Freddie, the rate lock occurs 45 days into the process typically, right? So we sign up an application, we get a quote from them up front with whatever the basis points are over the 10-year treasury, for instance. And that spread is an indication of where the market is at the debt, right? Based upon the leverage, the debt coverage, how much interest only, all those things. So in this instance, we order the appraisal, we do the inspections, we do everything we did for the small balance loan, except for when we go back for the commitment, they're going to issue that commitment again based upon those terms and what the prevailing spread is at that time. You know, the spread has a couple components that, you know, part of it's investor spread, the guys that are buying the bonds when you go to do the rate lock. Part of it is the Fannie and Freddie guarantee, servicing fees in there, and so it makes up the spread. There's a lot of times where we will issue a commitment and the spread is, say, 3 or 4 points different than when we apped it up. 3 days later, we can go rate lock, but when we go to rate lock, you're literally teeing it up with a group that has their bond desk go to the market and shop it like a package, if you will. And sometimes there can be 3 bidders, and sometimes there can be, you know, 7 bidders on your rate lock. And so recently, the one I mentioned earlier that we closed, we issued a commitment at a certain spread, and 2 days later, when we rate locked, there was enough bond buyers in the market where it attracted a lower spread, and we actually came in about 8 basis points lower.
Wow.
So in that instance, you know, that's one that happens closer to closing. And you're really just kind of subject to where the market is at the time. Now, when you rate lock, that is usually good for a couple weeks or so to go close. You probably have 3 good weeks. You know, if you wanted to get your rate secured because you're in an acquisition and then go get everything done for the closing, that rate's good for probably 3 weeks. You can have it good for longer, but it's free, let's just say, for the 2 to 3 weeks. If you want to have a longer rate lock, then they'll just add some to the spread to hold that rate for you.
Beautiful, beautiful. Thank you. Wow. Very, very, very knowledgeable, you know, very nicely explained. Let me kind of also take you to the, you know, prepayment penalty phase of some of these loans, you know, which are non-recourse, right? There are a lot of recourse loans. Local banks usually are recourse loans from what I understand, but Fannie and Freddie are non-recourse. Same thing, small balance also. I'm sure Freddie is non-recourse. So CMBS is also non-recourse, or is it is? And HUD loans, those are non-recourse. HUD
loans, yeah, all the agency loans, CMBS, and the small balance loans are all non-recourse.
Non-recourse, you know. And by the way, 2 things come to my mind. How many principals can be on the loan to kind of build the net worth up? That was one question. Then we'll go into the prepayment penalties and the defeasance and all that. If you could, in simple.
Yeah, on the key principals, people signing on the loan, yeah, it just varies. I don't think there's any sort of number per se.
Oh, okay.
You know, if you go in with 5 different, 5 people, it looks different than maybe just 2 or 3.
I see.
And part of that's, my job to kind of go to the lenders and sell partners, the group, whose role is what.
Yeah.
So it really just kind of depends on that front, I would say, more than anything, kind of case basis. You have more than one KP and there's a group of 3 or even 4.
Sure.
I'm developing kind of a story to kind of shed light on who these guys are and why they're partnering together. And, we try to define like a role of, well, this person's more hands-on day to day. Vinney's more the asset management kind of guy that oversees and, kind of delegates. And, we just kind of come up with a nice story.
Story. I love that word, story. I remember distinctly when you said, Vinney, let's just write a story, and you will guide me to kind of go through all that. Really closed on every single loan without a hitch, which I was very, very impressed. And I remember also, you may remember or not, Brandon, like, you say, Vinney, okay, let's meet, I got 15 different banks, local banks, they're having different terms. I'm going to have my office put together a matrix. I remember the matrix. And here you had 5 recommendations on the top and 7 at the bottom. And then you say, okay, I'll recommend, let's go with this bank because of
Right.
these terms. And we were able to whip it out quickly, Yeah.
Yep, yep.
Yeah. Huh?
Yeah,
So
I mean, that's what we have to do. We have to go out there and, kind of shop it around, bring back the matrix. And, there's always nuances between each lender that
sure.
can look the same, but they can still be different at the same time.
Totally. Let's go to the prepayment penalties and
Sure.
the defeasance. Yeah.
Yeah, so, well, the small balance loans with Freddie, we'll start with that. Their initial quotes are always with a yield maintenance penalty, but you can also get a step down, declining percentage of the loan amount. Means like on a 7-year loan, it's going to be 5% year one, 5% year two, and then it starts going down 4, 3, 2, 1, and so what your prepayment penalty will be any given year. Some people like that. That does add 20 basis points to the rate. So we have some quotes right now where a 10-year loan, I think, was pricing at 336, but for 356, you could have a step down prepay versus the yield maintenance prepay. The yield maintenance is a function of the bond market and where it's at versus your rate. That's the kind of easiest way to explain it. If you have an interest rate, when you go to prepay, whatever the remaining term is on your loan, they're going to go look for that treasury bond.
I see.
Rate in that bond is essentially the penalty year over year, though. So if you're 5 years in your loan, we'll be looking at the 5-year treasury. And so if your rate, just round terms, the treasury is really low, but if the treasury was say 1%, it's much lower, and your rate was 4%, well, there's a 3-point spread there, right? That 3-point spread is it's every year though. So essentially yield maintenance just guarantees the bond investor that bought the loan that they're going to get that interest. The higher the bonds go or in the future from today, let's say, because they're really low, the less impact there's going to be at penalty. Today, if we're locking in at 3.5, pay it off in 5 years, and the bond has moved back up to normal, 2.5 or whatever. Well, then now we only have a 1% penalty per year going forward of that yield maintenance, if you will, versus the 3% spread. The only difference between yield maintenance and defeasance is physically actually buying bonds that replace your debt that basically matures over time and gives the bond investor that bought the loan same interest they would have gotten versus and you're just paying it all kind of at once. It's the same calculation essentially. They can vary slightly, yield maintenance versus defeasance as far as the penalty, but defeasance is I'd say somewhere between $35,000 to $50,000 of cost. Paying for attorneys, you're paying for a company that's purchasing the bonds. So defeasance is going to be higher just from the nature of the cost aspect of actually defeasing and buying the bonds.
I see. Wow. No, thank you. But you're right. I mean, it's the people who are giving us 10-year fixed loan, so they are hoping to get that much interest and the principal back, right? So by paying, we are going to give the rest of the interest intact, even though they got the money already or no. We gave that money to another party in between, and now they're paying them, right?
Sure.
That's
Yeah, essentially, yeah. You're paying to buy these bonds, and the bonds are there maturing. That's month by month to basically give them the same return they would have received.
Wonderful. No, you've been so much great nuggets you've given back, Brandon. Anything else you would tell some new budding investors? What are some pitfalls that you have come across, or they just didn't really do the things they should have done, right, in buying multi or commercial, because that's what your specialty is.
Yeah, I think for the people that are out there trying to do it for the first time, just you just got to realize that like anything you go do for the first time or buy a car or house or whatever, there's going to be a little bit of a give and take. You may not get the highest leverage and the best rate, but you'll get a loan, you get your foot in the door. And then once you've kind of put that little notch on your belt that, hey, I've been there, done this, it's not easier by any means, but it's obviously opens a few more doors that wouldn't be there otherwise. I'd also say that a lot of times when people come to us for the first kind of deal and they're looking at something, they've underwritten the property, but they really haven't looked at the market enough. That's one comment about maybe pitfalls is that, make sure you study the other assets that you're going to go compete against too, and know what they're doing. I ask, well, what kind of rent comps have you looked at, or have you shopped the market, or who do you think the biggest competition is? And people don't know. And I think that's a very, very important piece of you're buying something, knowing, know more about what you're buying, meaning the submarket and what's really driving area and the tenancy.
Makes sense. Totally makes sense. Makes sense. Brandon, how can people reach you, bud? And how can they get in touch with you? Website, anything you'd like to share with us?
Yeah, the easiest way to get in touch is obviously email or a call. You can go to our website. It's just very simple, lmicapital.com. And it has all, everyone's contact information out there. My email address is bbrown@lmicapital.com.
Sure.
That's the best way. Just send us an email, say, hey, we're thinking about looking at something, or want to get your take on my financials. We'll just set up a call, go through the financial statement, and try to advise people on what's feasible, because a lot of times, even though you have net worth of say 3 or 4 million, we may suggest going for something just a little smaller because of liquidity or something that more feasible. We want to set someone up to succeed, not putting a square peg in the round hole. So
exactly. And then later on, say, hey, that didn't work or that didn't work.
Right.
The best thing I have really enjoyed, 29 syndications, whatever I've done or so, is that closing, having a great loan broker has been the real strength. Real estate attorney, Milton Colgrove, great friend of mine, and you have really helped along with another gentleman in Dallas, and then now another one there in Florida, which my partners had the built-in relationship with. But you're a very, very, very important piece of the whole puzzle. So thank you for your time, bud. I really, really appreciate that. And I just want to tell the audience, hey guys, if you like what you have heard and the benefits of owning and investing into real estate, reach out to us. Our line is always open to see if we can help you achieve your goals in passively investing. We'll meet with you and strategize if you want to learn about syndication. My academy is open. We are into senior living, build-ups. We are into hotels, hospitality, everything. So please visit my website, vinneychopra.com, vinneychopra.com for more information. And if you'd like to invest with us, please also go to vinneychopra.com/invest. And then don't forget to like, subscribe, and comment and share this episode if you found value. And if you think someone will also find value in it. Thank you again. Thank you, Brandon. It's a pleasure, bud. Look forward to seeing you, and be well, and hope your family's well and everybody. And look forward to talking to you again. Bye-bye.
All right. Thanks, Vinney.
Thank you. Thank you. Bye-bye. There we go.